let's see where we're at. Okay. We are streaming live on YouTube. Hello, YouTube, and welcome. This is the Credit Banking Mastermind number 33. And of course, you see I'm at home, working from home. I'm a wise guy. This time I'm in tie. See that? But this is actually my Wise Guys and Ties t-shirt. So I can be fancy without being fancy, but I'm still fancy without paying for being fancy either. So this is great. You know, some people have asked like, oh, that's a cool shirt. Yeah, so we've got these Wise Guys and Ties shirts that have this cool little logo on the back about, business credit and getting started building your business. If anybody's interested in that, just go ahead and private message us and let us know. But, you never know when you might need to throw on a tie, and you can get by simply just wearing a Wise Guys and Ties t-shirt. All right. So we are live on YouTube. This is great. Welcome to everybody on YouTube. Welcome to all the folks that are joining us on the Mastermind in the Zoom webinar. All right, so what I'm going to do is I'm going to share my screen. Hopefully everybody can hear me okay.
Yes, sir. We can hear you good. Definitely.
Hold on. Okay. So I need to go to share. I'm just going to share my screen. Here we go. And then I'm going to start the presentation. Cool. And everybody should be seeing, the screen. Perfect. All right. So what are we talking about today? This is Credit Banking Mastermind number 33. Can you believe that? 33 weeks we've been doing this. Wow. I'm super excited. This is going to be great. So what are we talking about? Credit banking and the search for the lost American dream. We cycle through we break this up into about 3 or 4 trainings, sometimes 5 trainings. And we just completed credit banking with business credit last week. And it was a phenomenal training. A lot of people gave a lot of good feedback on that. But this week, we're going to start all over, and we're really going back to the beginning, back to basics. So this is going to be great. You're going to love it. We're going to dive in. Of course, every credit banking mastermind, we do a little bit of training here in the beginning, about 45 minutes to an hour worth of training. And then we jump into a case study where we implement, what we try to do is practice so that we can get really good at what we're doing. So let's go ahead and dive right on in. So Mr. Ray Fleming, would you like to read our disclaimer, please?
So we are not licensed attorneys,
Mr.
accountants.
Fleming.
Can you hear me? Can you hear me? Yeah, you can hear me, right?
Mr. Fleming is having some difficulty with his tech. So basically, we'll
you
just
can't hear me?
The disclaimer then, but it's still there. You guys have to read it.
Huh.
Basically means you need to do your own due diligence, folks. You need to make sure that the information that we cover here is going to work for you in your own situation. Hey, we had somebody join in here in chat. All right. All right, everybody's able to hear me. Thank you so much for the feedback. Always need that. So if you're looking for any way to contact the Wise Guys and Ties, our information is right there on your screen. You can call us, email us, go to our website, schedule an appointment if you're looking to work with the Wise Guys and Ties. Again, my name is Joseph Smith. My business partner is Ray Fleming. We are the Wise Guys and Ties. Wise in the ways of helping you eliminate debt. Wise in the ways of helping you start, build, and grow a business so that you can achieve whatever you were put on this earth to do, your God-given purpose, whatever that dream is, that desire that only you know that would fulfill you. That's what we're here to do, help you get the resources and the tools that you need to do that. All right, so let's move right along. So what is this? Hey guys, I am super excited to be able to tell you about my new credit banking book. This has been a labor of love. I've sat down, what do you do when everything gets shut down for months? Well, you sit down and you start writing a book, right? So I've spent since April through July working on this whole credit banking strategy, putting it step by step into a book, all the things that we cover each and every week, plus a few added extra information. A lot of this thing is just chocked full of everything that I've learned on the credit banking strategy over the past few years. So this is the new credit banking book. I'm excited to bring this to you. Um, it's it's going to be live on September 1st. You'll be able to order it like on Amazon or any place like that. However, we are running a pre-order special, but let's tell you a little bit more about what's in the book. So people are like, especially if you're new and this is your first time, you're like, well, what is credit banking? Well, credit banking utilizes your budget surplus and revolving lines of credit to transfer highly expensive amortized loan interest into a simpler and less expensive repayment plan. This plan radically decreases the total number of loan payments, which in turn reduces the total amount of interest paid, resulting in aggressively paying down of the principal loan balance in about 1/3 of the time. So a lot of people, wondering what is credit banking? Man, this is an excellent strategy, a tool to eliminate your debt fast. So we talk about why credit banking, rapid debt reduction, which I just said. It helps us to increase our monthly cash flow, to increase our cash availability, creates financial independence, maximizes your real estate returns if you're in real estate, reduces stress and burns calories, and helps you become more attractive. Let me tell you, I am way more attractive to my wife when we have eliminated hundreds of thousands of dollars in debt than I am when we are swimming in hundreds of thousands of dollars in debt. So why doesn't everyone do this? Well, a lot of people just don't know about it. Many banks don't want you to do it, and the mainstream media doesn't even understand it. Financial advisors have never heard of it. Dave Ramsey doesn't teach it. Lou Dobbs didn't do a news report about it. Mom and dad didn't do it. Your broke uncle said not to. And the bottom line is just people fear it. So a little bit about me. Normally I have Ray read this part, so it doesn't sound so self-fulfilling, but I want you to know a little bit, like, what does this offer? Why should I be listening to you? Well, after going to college and getting a degree and getting a job, house, car, married with children, I found myself broke and going through 2 foreclosures and a bankruptcy. So yes, you're going to learn your financial strategies from somebody who's been broke and gone through 2 foreclosures and a bankruptcy on his record. Now, I tried to do everything right, but somehow everything went wrong. And I felt like a complete failure until I learned that the financial system was rigged against the individual. And it was at that point that, I learned that, well, this isn't all my fault. So now I can start learning the system and how it works. So I need you to know right off the bat, of course, I'm not a licensed attorney, accountant, financial advisor, broker, or any other licensed individual. I'm just an average guy who stumbled across the solution to break free from debt and the banking system to truly become financially free. Now, I hope that you'll enjoy the way I put the book together. It's a straightforward explanation of the whole credit banking system, but I tried to explain it with some storytelling, some funny anecdotes, analogies. Definitely, this is from the layman's perspective. So you can pre-order today for the book and have it shipped out to you on September 1st. So what does that cost? Only $59.99. And what do you get? Well, you get the paperback version of the book. You get the ebook. You also get the audiobook. I was in the studio for the last 2 weeks recording and laying down the audio track. So you can have the audiobook version as well. A lot of times we work each and every week and we use the credit banking calculator. And a lot of people are always asking me, hey, how can I get a copy of that? I want the credit banking calculator. So we've thrown that into this bundle as well. And then we do a lot of budget spreadsheets to show you, because a lot of people have trouble with budgets. In fact, that's what the main topic of today is learning how to manage and keep a budget so that we can create positive monthly cash flow. But so if you pre-order today, how do you do that? How can you get this ordered? Go to wiseguysandties.com/books. And right there on the page, you can order the credit banking and the search for the lost American dream. It's $59.99, and you get the paperback, the ebook, the audiobook, and all the other bells and whistles. We're throwing in charts and graphs and so many other ways to help you be able to understand how this works. We've got some PowerPoint materials in there as well to help you so that you can really learn this information. All right. So, oh, I see somebody came through on the chat. Okay, so see if we can fix the technical issue here. Let's see here. One moment, folks. We're just having a bit of a technical issue, and we'll be moving right along. I just have to figure out how to fix what we're doing here. So, all right. So I had to click on 3 dots to allow Mr. Fleming to turn on his camera. So let's see if he can do it now. Mr. Fleming, is your camera working now? There we go. Is your audio working? Say hello to the folks.
Hey, everybody.
No audio?
I think they can hear me. I think you can't hear me.
You can hear me, but I can't hear you.
I can hear you, and everybody else can hear me, but I don't think you can hear me.
Oh, that's because I was muted. Yes. Okay, I see now. I'm so used to having the second screen, so I don't have to do that. Okay, there we go. So, all right, perfect. Everybody can hear Ray. I couldn't hear you because I was muted. All right. Well, welcome, Ray.
Thanks, Joey. Good to be here.
Show everybody that Wise Guys and Ties t-shirt you got.
I know, that's pretty fancy. Are we wearing the same color tie today?
I'm wearing the blue tie.
Oh, I got a red tie. Okay, good.
All right.
Good,
cool.
Good.
Awesome. All right. So let's jump right on in. All right. So what does it take to do the credit banking strategy? Well, folks, it's a mindset. See, most folks, when they come into this and they don't understand what it is, they're used to their employee mindset. Maybe you have a W-2 or a 1099, and you're used to just taking all your money, putting it into the bank, and living on a cash basis mentality. And what that does is that creates scarcity. And so what we need to do this is we need to help you get to the point where you have an abundance mentality. Because you see, wealthy folks, they don't do that. What they do is they leverage their currency and use their cash to accelerate the growth of creating an abundance mentality. Think of it like this. Here's the best way that I know to explain it. Have you ever played that game? What would you do if you won $1 million? Ray, you ever played that game?
Oh yeah, all the time, every day.
Put yourself back in the W-2 mindset and answer that question. What would you do if you won $1 million?
Pay off debt, buy a new car, buy a house.
Awesome. No money for your friend Joey?
Maybe I'd probably donate a little bit of money, but pretty much would spend it all.
You wouldn't give me $10?
I'd give you 10. I'll take you out to dinner.
All right, perfect.
Steak dinner, no dessert.
Now, a lot of people, especially on this webinar, you're thinking, oh, no. I'm much more, my thinking is much more evolved. I definitely know that I wouldn't do that. So Ray, talk about when you became an entrepreneur and you changed that mindset. How would you, what would you do with $1 million then? Talk about how you would invest it.
I would definitely go out and get some rental properties easily. I would more focus on probably 2 small apartment complexes for $1 million. Yeah, 2 small apartments.
Perfect. Now, here's the thing that blows my mind is that when you implement this abundance mentality, what the wealthy folks do, they don't even do that, Ray. Like that's what you and I would think we would do. Yeah, $1 million. Yeah, let's go invest that. But here's what the wealthy do. The wealthy, what they do is they take their $1 million and they leverage that to get access to $10 million of other people's money. And then they spend that to maybe go get them, maybe several apartment complexes. But the cash they keep on hand as reserve to pay down the money that it takes. So the debt service on that $10 million, they would keep the $1 million on hand to do that. I mean, what they want to do is create an asset that would pay for it, but the $1 million is there as a safety net so that they could use that for the debt services if need be. So keep that in mind. So what does it take to do credit banking? We haven't even got into this and we're talking about mindset. It's because if you're used to thinking about things in terms of making a paycheck and putting it into your bank account and paying your bills, and then do the same thing and every 30 living in 30-day cycles, then we've got to help get out of that mindset so that you understand that the goal is to learn how to leverage other people's money, pay your debts down with other people's money, and keep more of your liquidity and cash on hand for what you need. All right. That being said, so what do we need to get started? Well, there's 3 ingredients to credit banking. Ray, do you know what they are?
First, we need debt.
Yes.
Next, we need some type of line of credit or credit banking tool.
Try again.
Cash flow?
Yes.
Positive cash flow.
Positive monthly cash flow, a budget surplus. Then we need the line of credit.
Yes.
Perfect. Good job. See, I'm always trying to keep you on your toes. All right. So that's the ingredients. Like if we're baking the credit banking cookie, we need debt, we need cash flow, right? And we oh, there it is. What's going on? There we go. So we need debt, cash flow, line of credit. So most people here probably already have debt. So you already got the first ingredient. Cash flow is tricky for some folks.
Mm-hmm.
Some people are living in the red right now, especially in hard economic times. So how do we increase cash flow? We're going to talk about that today. And then line of credit. Line of credit is going to be the way, it's going to be the vehicle or the tool, like Ray was saying, that we use to eliminate all of our debt. So let's talk about what is the lost American dream. Well, that means a lot of things to a lot of folks. I mean, is that a house and a car or 2 cars and the wife and the husband or the, you know, are we talking about 4 kids, 6 kids, 12 kids, no kids, right? I mean, what is the lost American dream? Is it traveling, seeing the world and living on room service? Everybody's got a different opinion of what that might be. But at its core, I would say that it's financial freedom. Now, the whole theme of this webinar, as you can see, is got an Indiana Jones theme. That Paramount movie starring Harrison Ford, great movie, love it. Just watched it over this weekend, and it stands the test of time. But I show this because Indiana Jones in the first movie, when he's going into that South American temple to get the golden idol, man, he does everything right. He knew about the booby trap. He knew he followed the map and how to get past some tribe that was guarding the temple. So he was able to get past them. He got to the entrance, and then there were spiders, and then there was a bottomless pit. Right, there was some kind of booby trap with a "don't stand in the light," right, or these spears come flying out. I mean, he does all that right. Then he gets into the throne room here, and then there's even more booby traps that are different things flying out of the wall, and he's able to sidestep each of these traps, and he gets to this final one, and he knows that there's still another booby trap. This idol, this pedestal, is pressure sensitive, and so he's got to swap it out. But, you know, he's not sure how much that golden idol weighs. He drops out a little bit of sand in case his bag's too heavy, and then he swaps it all out. And, man, he did everything right. And but then what happens? Well, great cinematic movie is what happens. The whole temple falls apart around him. He's running, he's jumping, the door's collapsing, and he's got to get out and get his whip. And then this huge boulder starts rolling after him, and he's just barely, making it to the entrance before he'd get trapped in there forever. I mean, so it's fun to watch. Great movie. But what does that have to do with credit banking? Well, folks, do you ever feel like in your life you did everything right? You went to school, you got good grades, you did that so you could go to college to get a degree, and then you went and got that job, and then once you got the job, maybe you got married in college, or maybe you got married along the way, but then you get the house and the cars and the kids, and then the kids are involved in baseball, and they're doing all kinds of activities, karate maybe, or they're in dance or doing other things. And before you know it, you're over $500,000 in debt, and you and your spouse's combined income is maybe $80,000 a year, how are you going to live off of that and pay off all your debt? I mean, what are you going to do with over $500,000 of debt? What would happen if you missed like one payment, right? It's crazy. And are you on track to retire? So look at this. I show this because look, folks, we're going to talk about credit banking, but it's always, we got to always think of the end in mind, right? Someday you're going to retire. Someday, are you going to want to retire with what? Enough money to live off of comfortably? Do you want to work until the day that you die? I mean, everybody's got a different idea, but look at this. This is a pretty good. I like this this picture here, this graph, this chart. It shows the amount of money needed per month. So think about this. Most people live 20 years after retirement. So if you want $3,000 paid out to you per month, you need to have over $1 million sitting in a retirement account that's earning you some type of interest rate, a small interest rate. It's going to be based off of the market, but the market ebbs and flows. But for 20 years, you should be able to live off of $3,000 a month. But I mean, is that going to be comfortable for you if everything's paid off and you don't have too many bills? Maybe that's good enough. Maybe you want 5,000, 7,000, 10. Look, what kind of lifestyle do you want to live in? Or maybe you're like, I don't want to wait till I'm 65 to retire. I want to retire now, right? Well, if you want to retire now, well, do you plan to live for another 40 years or more? Well, look at the kind of money that you need to have, right? This is considered the nest egg approach to retiring. How much money can you build up and then live off of that nest egg until it runs out? So this is where a lot of people are at. So when you think about the fact that you do everything right and you're stuck in so much debt, how are you, while being stuck in so much debt, going to be able to meet whatever your financial goal is for retirement? I mean, it's not even possible, is it? Folks, let's talk about your financial freedom goal. I mean, we need to know what's the exact goal. Do we really need to have $1 million? Do we need to have $3 million? I mean, it would be nice, but what do we really need to have? Well, if you set aside the nest egg approach, let's look at this another way. Financial freedom happens when your passive income equals your monthly expenses. Ray, what's passive income?
It is funds that are just coming in because of an investment you made, a business that you own. It isn't requiring you to actively go out and make it, trading your time for that money.
Exactly.
Which is where it all comes down to. I mean, we cannot survive for long periods of time without the cash flow.
Absolutely. So we come up with a very simple equation here for you guys to understand this. So to figure out our financial freedom goal, the amount of money that we need to take our monthly expenses minus our passive income, and that'll be our financial freedom goal. So for example, if you have $3,000 a month in expenses and you currently have zero passive income, then your financial freedom goal is 3,000, right? I mean, that makes sense. If you had $3,000 a month coming in passively, would you have to work at your job? Some of you would say, well, yeah, I need the benefits, or some people would say, I like my job. Other people would say, no, right? Exactly. That's the point. If you could get all of your expenses covered, then you would be freed up to pursue your dream or whatever your God-given purpose is. And then who knows how much money you could make and what you could do with that. So how much money do you need to invest to create the passive income needed to reach your financial freedom goal? Well, let's take a look at this. I got another equation for you. So if we take the financial freedom goal that we were talking about up here and we multiply that by 12, then we know how much money that we need for a year. But we need to divide that by our ROI. Ray, what's an ROI? Ray Fleming, what is an ROI? Mr. Fleming, are you there? Hello? Ray, can you hear me?
Can you hear me?
There you go. I
Yeah,
can
that
hear you
was like
now.
froze up. All
Wow.
right. Sorry, go ahead. Yeah,
So
you froze for a second.
my question was, what is an ROI?
ROI is the return on investment. So the percentage of return or profit on the amount invested.
So can you tell me, when it comes to rate of return and risk involved, um, what if you know, let's say like a 1% rate of, could be a rate of return, right? 10% could be a rate of return. Could you explain the difference between those lower rates of return and the higher rates of return as it relates to risk?
Oh, yeah, perfect. Because if we look at savings account is by far the safest investment there is. It's insured up to $250,000. You're pretty much not going to lose your money if it's in a savings account. So the rate of return is going to be so small because it's the safest. Next, we have CDs. There's a little bit of risk, but not much at all. So they're not going to pay much at all. It's going to be minimal, 1% at the max. Now, moving forward to having a rate of return in some type of mutual fund, stocks, those are getting a little bit more riskier because you're investing into a business. Um, and then as you start to invest into different aspects of real estate, depending on, let's say that your first position lien holder, like a bank, a bank having a loan on a property is a pretty safe investment as far as the bank's perspective. If you default, they get a property. So it's pretty safe from their eyes. And so you could expect anywhere from 3% to 8% guaranteed percent return. And then if you're willing to, say, come in at second position, somebody has a mortgage and you're willing to lend some money maybe for rehab, let's say $30,000, then that's getting a little bit more risky because now there's a lien holder in front of you and now you're second in line. That is going to warrant a higher interest rate. So let's say that somebody might want to do 12%, and then somebody could be even third position. Now if you wanted to be three pieces behind, then that could make 20% return on investment. But the risk is much higher because if that person was to default, there's two people that are going to get paid before you. So you really need to know what you're doing at that point.
Absolutely. And then, of course, there's other types of investments, like people talk about Bitcoin. There's the stocks. People day trade. People do currency exchanges. You know, there's all kinds of things that are out there.
Yeah, the key really is you got to know what you're getting yourself into. And it's not necessarily, I don't see a lot of these things that could make a 20% return. I don't necessarily see them as risky if I know what they are. Now, I know in Bitcoin and other different places, you could make those monstrous returns. I just don't understand it enough to make sure that I can, I'd be more of a speculative investor instead of a knowledgeable investor at that point.
Right. I've heard it said that there really is no risky investment out there. There's only risky investors, people who aren't educated in the type of investment that they're putting their money into.
Absolutely. I mean, that's spot on. It's the risk is in the investor.
Perfect. All right. Well, thanks for sharing that. So, since we got a little bit, we had a little bit of lag, I'll go back and say, so we're looking for the financial freedom goal, right? That's what we already calculated up here. How much, basically take all of your monthly expenses and multiply that by 12. And then we want to divide that by whatever we want for a rate of return, whatever meets our risk tolerance threshold. And then that'll equal our total amount invested. So let's look at another example here. So if I have $3,000 in monthly expenses and I multiply that by 12, then I'm going to come up with $36,000, right? But I'm looking at investing in real estate and getting a 10% return. Now, Ray, is it difficult to get a 10% return in real estate if you know what you're doing?
No, not in real estate. That's pretty easy.
Okay. I mean, that could be done through, I mean, several types of things, right? We're talking about fix and flips, wholesales, holding on to certain rental properties over a period of time. seller finance notes, right? I mean, there's even
Yeah,
tax.
especially, yeah, I mean, an annual 5%. I mean, rental properties, I regularly see rental properties creating 100% returns, annualized returns. As far as like the cash on cash investment, if leveraged properly. Fix and flips, I would say, you know, sometimes those are averaging around 5 in a tight market. 5, it could be all the way as much as 20% return. You do that a couple, you know, 2 or 3 times a year. Now we're
Yeah,
talking 15 to
perfect.
60%.
I agree. Now, why are we laboring this point? Why are we spending so much time? Because look at this. To achieve our financial freedom goal, I could have done the other strategy, right? Get the nest egg, need $1 million to $3 million just to have maybe 5,000, $3,000 to $5,000 a month, right? But what if I outlive my money? Or what if the stock market takes a big hit and I lose half of my nest egg, right? There's a lot of things that can happen. But here in this example, all I need to have invested is $360,000, earning me a 10% rate of return. And that would give me enough money coming in on a monthly basis, a passive income to take care of all of my expenses. So a lot of times when we think about the end of mind, what is that goal? What do we need to, where do we need to be to have the money that we need to retire? Well, it depends on, do you want to do some type of investing approach, or do you want to do the nest egg approach? The nest egg, I believe, ultimately creates scarcity because every time you take something out, it gets a little smaller, especially if you're not putting anything back in. And what happens when the economy or the stock market hits its highs and lows? It drops, it falls, but then it comes right back up. But does your investment come right back up when the stock market comes up? Not always. A lot of times people's investments take longer to regain the losses than the stock market itself. So this is just another way I want you to think about things, because we've been able to help so many people, especially if they're a little bit older and feeling like they don't have enough time, to see that you can achieve your financial freedom goals, you can achieve your retirement goals at a much cheaper amount than what the financial gurus out there are telling you. They, you know, the different brokers out there want you to invest in their firms and they want you to build up multi-million dollar portfolios. But, you know, that's great. But do you need to? No, I mean, there's other ways to achieve your financial freedom. And I wanted to show this to you because what does it matter if we eliminate our debt? If we don't know how we got into debt and we don't know where we're going, we're just going to end up going right back into debt. So folks, we have to know where we're going. We have to know what the plan is, right? That is critical. That's why we talk about this. So for me, this is where I need to be at. So I'm, you know, I'm not too far away from hitting my financial freedom goal right now, based off of working with the property guy, Mr. Ray Fleming, and in our real estate investing businesses. We are well on our way. So, which is great because I mean, we have employed a lot of money and we've invested in a lot of properties and we're doing a lot of good things and helping a lot of folks. But we decided real estate investing was the way to go. But we did that after we got educated. And so we have really mitigated a lot of our risks by knowing what we've done. So, I mean, we have not lost any money yet on any property. There's always a chance that there's going to be a first one, but Lord willing, we'll be able to make money on each and every one of our investments because we have tried to make educated decisions on each of those properties. So, folks, whatever you're into, whatever you want to invest in, get educated about it, right? Learn how to do it, and then you'll have better control over your retirement. Okay, so what keeps us from our financial freedom, right? It's that $500,000 of total debt I was talking to you about, right? You and your spouse have a combined $80,000 to $100,000. Well, but you have over $500,000 of debt. Those are those natives running after Indiana Jones, right? Those are your creditors. They're coming for you. If you don't pay, right, then your house gets foreclosed on. They repossess the cars. I mean, a lot of people who have made a lot of money, you'd be shocked to find out that they're just broke on a higher level. Ray and I work with lots of clients, and We have people who are just absolutely dirt poor, college students who have, nothing, and they don't know what to do, and they're just trying to break free from their student loan debt and maybe start a business. And we've worked with people who have, the house and the cars and everything, and they've got the big job, but because if the government shuts down, or the economy shuts down, or you get downsized, we've had a lot of people who are, even though they're making a lot of money and they have a lot of stuff, they're really months away from going into bankruptcy. So how can we avoid all this? Well, we've got to have a map. We've got to have a map to find that lost American dream, right? Because we weren't meant to go into the hundreds of thousands of dollars in debt, right? That's like just being in slavery, right? It's indentured servitude, right? So how do we get free? How do we break free of this? Well, we got to have a map. And so each and every week, what we cover is budget, lines versus loans, credit banking, and we also talk about business credit with credit banking. And these are the ways that we put the map together. So today we're talking about budget. And I'm super excited to go over this with you because we cover the numbers of the average two-income American family. And you might have seen this on other YouTube videos. This gets covered a lot. There's a lot of people who go over this strategy. It's called sweep strategies by some. It's called velocity banking by others. It's called cash flow banking. I've heard it called, a portion of this is in what's called infinity banking, although infinity banking encompasses a lot of other things in that. So there's a lot of different people talking about this in a lot of different ways, and they utilize a lot of the same examples because they pull their numbers from the national averages from the last census that was done in 2010. So obviously we have another census coming out, so you're liable to see a lot of these numbers get updated soon. But the point is that this strategy goes by a lot of names, and we're going to call it credit banking as a very generic term. And it encompasses all these other different approaches and all these slight nuances. But where does credit banking actually come from? It's not something that I thought up. It's actually a strategy that was first conceived of and implemented in Australia. In fact, it's the way that most folks in Australia buy their homes these days. So we're going to utilize the down under strategy and see if we can implement that here in the States. So the average two-income American family with no children, after taxes and all of their if they have long-term disability, they have dental, health, whatever their deductions are, their net income is $5,000 a month. So let's take a look as they're trying to avoid those arrows from the darts from the natives, right? So the first wedge is, so they take their money and they put it into the bank, right? Living on that cash basis mentality I was telling you about. Here, I'm going to hide my picture just for a moment so that you can see what we're talking about over here. So what you see here are loans. So we're separating it. These are different bank products. So one bank product is a checking account. You have another bank product is a savings account. Another bank product is a loan, right? So you put $5,000 of your net income into your combined net income every month into your checking account. Well, you're living on a cash basis mentality. So that means you only have so much money in this pie, and you start slicing off the wedges. The first wedge typically goes for your home loan. Now, not everybody's living in a home loan. Not everybody has a mortgage. Some people are renting, but still, whether you rent or you have a mortgage to pay, this is where you have the first, the biggest, largest amount usually allocated for your expenses. So here we have a loan for a house, $200,000, and we have $1,200 a month in principal and interest payments, and that's at 6%, right? So the 6% average. Now today, I mean, people are getting interest rates half of that. So we're looking at an average, right? So that means if you have great credit and you can get 3% or less than 3%, awesome. If you have less than stellar credit, well, you're probably going to get a larger percentage, right? That's just the way it works. So after we put the $1,200 a month there, then it's time to look at the next wedge, right? What else do we have? Oh, well, we have two income American family. So we have two cars. They both drive to work, except for, some of these things I think are going to shift with the way things are working in today's economy. A lot of people are learning that they can work from home. So maybe they won't need two vehicles. Maybe they'll be able to get by on one, or, or maybe both people will still have vehicles because they'll have other things that they'll need to do. Either way, um, the average, the average auto vehicle payment is $300 per vehicle. And the average amount of debt currently being carried on a vehicle is about 13,000. So I just added up, two cars, two car payments. So you have $26,000 in debt and you have $600 as a monthly payment. All right. So we've got a checking account. We've got two loans already. What else we got over here? Oh, we've also got a $600 minimum credit card payment that has to be made every month. Can you believe that? $600? Because the average two income American family, when these stats were taken, has a $15,000 limit. In fact, I can tell you, I looked recently and that's actually closer to $18,500 today, an $18,500 limit over personal line of credit, overdraft accounts, personal credit cards, secured lines of credit. And so this is where people are at. Now, back when these stats were taken, the people were carrying a $12,000 balance. Today, I've seen that the balance has creeped up to about 15,000. So, as we run our numbers, we want to update these slides as well. But there's still a gap in there of $2,000 to $3,000. But people are running as you can tell, they're running their balances pretty high, and all of that's at 21% interest. So $600 spread over, this could be 3 credit cards. It could be a line of credit, a couple of credit cards, and an overdraft account. But whatever it works out to, your minimum monthly payment, just to make the minimum payment, is $600 a month. All right. Now we have this next wedge, which I call your lifestyle. This is going to be different for every family. So this is a 2-income American family with no kids. But what if you're single, right? Then your lifestyle expenses are going to be different. What are your lifestyle expenses? Do you pay for insurance, gas? Do you pay for, health insurance, right? Extra health insurance, life insurance? What's your power bill, water bill, food bill, right? All of these things. Anything that supports your lifestyle. Do you eat out? Well, not many people are eating out these days. Do you go to the movies? Well, if they would open up, maybe. I don't know, right? So everybody's lifestyle here is going to be different. But if this was a 2-income family, but let's say they had 4 kids and grandma was living with them, well, then this number is going to be different. So while I'm sharing with you these budget numbers, and they might be a little bit dated from the last census, from the Bureau of Labor and Statistics, the point is that it doesn't matter what these numbers are. The principles of credit banking are still going to apply. And even if these numbers don't match your numbers, maybe you don't have auto loans, you have a home loan, maybe you have student loans, right? Or you have a personal loan, a business loan, right? You could have any. These numbers can be different. You can have a different variety assortment of these things, but it's important to know that pretty much everybody has some type of budget where there's money coming in and there's money going out. But once you have taken care of your monthly expenses, your lifestyle expenses, and you've made your minimum payments on your credit card, your auto loans, your home mortgage, now it's time to have your savings account. And the average 2-income American family is putting away $1,400 a month in savings. And when I first saw that, I was like, yeah, right. That's not happening. Are you kidding me? $1,400 a month? I don't think so. So here's where this number comes from. After you're doing a little bit of digging, this is really people putting their money into their 401k or their IRAs or long-term savings plans. A portion of this could be people putting money into an actual savings account, but not a lot of people actually put money into savings account. That's why this kind of threw me off, because I was like, I know people aren't putting away that kind of money. But the way that they lump everything together for the purposes of putting all their numbers together, you've got an average two-income American family that might have a 3%, a 4%, a 6%, maybe even higher. They allow you to put away 10% of every paycheck every month into your 401k, right? Well, you got a two-income American family getting paid a total of 4 paychecks in a month. You can easily see where we get to $1,400 a month going into a 401k type of plan with their employer. Now, some people put money into savings accounts, but a lot of times what happens is as quickly as you put the money into the savings account, you pull it right back out because you need it. But some people save up for maybe Christmas is coming, so let's put some money aside so we can get the kids some toys. Or what else do people do? Sometimes people want to do an upgrade, to the backyard or the kitchen, or maybe a spare bedroom. So they put some savings aside to be able to do a special project of some kind. So a lot of times we do save, but it's for a very short period of time, and we're constantly dipping back into the savings account. So a lot of people don't realize that savings accounts are really just the bank's lending pool. I mean, where does all this loan money come from? The auto loan, the home loan, the credit cards. Well, it comes from the money that you put into the bank's lending pool, right? So if you put money into your savings account, right, because the bank has this special deal where when you open up your checking and your savings account, you get some type of cash incentive, or you get some special that the bank's offering. Well, you've opened up and you have to put so much money into the savings account, and you have to leave it there for a certain period of time, right? Well, and then they use some kind of fractional lending. What's that specific term called again, Ray? Not I know it's fractional reserve lending.
Fractional reserve, lending, fractional reserve banking.
Yeah, and would you explain what that is? The insidiousness behind that?
Well, what it really means is banks actually get to create money. They only need a certain fraction of the amount on deposit, basically, that they need to keep in order to lend out. So, for example, let's say that I deposit $1,000 with the bank. The bank can keep $1,000 or keep about 10%.
$100.
Yeah. Well, all they need is about 10%. So on that $1,000, they could lend out $9,000 for that $1,000 that I deposited.
Oh.
So yeah. And so if I have $10,000, then that's $90,000 that the bank is able to lend out.
It's crazy. Well, what would happen if we did that, Ray?
Go to jail.
So, but another thing is, when you put money into a savings account, don't they pay you interest?
It's a fraction of a percent. So 0.00, it's a fraction of a fraction, basically.
Well, let's just say 1%.
1%. I mean, they're turning around and they're making almost, a 900. Well, actually,
well, what about
it's way more than that. It's like astronomical how much they're making. It's crazy.
Well, I know you look at a lot of different things, especially index funds when it comes to life insurance policies. I mean, I know that's a whole nother discussion for another time, but why is it important to have your money keep up with an index fund that might be at 3.5%, 4%?
Well, because then if you're not at least keeping up with the rate of inflation, then you're losing buying power. So every year, the dollar is devalued by the rate of inflation, so your buying power is reduced, and if your money's not even keeping up.
I agree. Let's define inflation. That's the devaluation of the dollar as opposed to the rise of the cost of goods and services. So you combine those two and you get a ratio, an inflation rate, and that's typically hovers around 3%. I mean, a while back there, it actually got into the mid twos. That was nice. but yeah, so the inflation rate hovers around 3%, right, Ray?
Yeah, it does. I think what was it? I just yeah, where are we at right now? Yeah, we're somewhere right around 2 right now, I think.
Okay, great. So if you are making 1% return on your money, but you're losing 2% of your buying power every year, are you getting ahead in a savings account?
Nope, not at all.
But you said it was the safest investment earlier. I heard you say that.
It is the safest investment as far as not losing the principal investment amount, I guess is um
It's the safest
you're
investment if you don't take inflation into account.
that is true. You know what? I'm just realizing now, you know what? We are, it's not even the safest because we are losing. I
And
mean, it's the safest in the amount of how much you can lose. I
sure,
guess maybe a CD would be a little bit better than that, even though you're still losing typically in a CD.
if you could get a CD that was above the inflation rate, then you would be doing well. But we'll take a look at this. So the interest rate on the loan and the auto loans was at 6%. Is the bank being able to take your money to make money and still stay ahead of inflation?
Oh, absolutely.
Well, so the bank's doing pretty well, but it doesn't look like this two-income family is doing too well.
Nope, not at all.
So with the 401k money, where does that all go? It gets automatically deducted from the paycheck. Where's it sent off to?
Well, you get to pick from the shopping menu of, you want it to go to the Janice Triton mutual fund, or maybe there's some index funds on there, but typically it's going off to some type of mutual fund. And a lot of people don't even understand that, there's a reason out of, right now there's probably, I think, close to 10,000 different mutual funds, but you may only have a shopping list of, I don't know, 20 or 30 that your HR department offers you, or your 401k plan offers you, because they have to pay to get on there. So there's a big cost for them to even be on that list. Once then you divvy it up to them, and they're just simply day trading. Their businesses, their financial businesses, they basically invest in the stock market and bonds and different aspects. And so a lot of times people don't even realize that it's different from just investing into the stock market. You're investing into a business that invests in the stock market. So it's very unstable and uncertain what can happen in there.
Well, but I mean, so it's the stock market. So the money's going to Wall Street. Wall Street's making bajillions of dollars. So, man, if they're going to be making money, let's just jump on the bandwagon, the gravy train, and scoop up some of that for us, right?
Not so much in mutual funds. Mutual funds are just so I just don't ever recommend anybody being in a mutual fund. If you're going to actually be in the stock market, and look at index funds.
You should probably get into day trading. But so here's the thing I'm thinking about. You give in a savings account, you give your money to the bank, and they go and make money off of your money, but you're not really making a whole lot of money. You're making 1%, but you're also losing anywhere from 1 to 2% of your buying power to inflation every year. Now, when you give money to the stock market, your broker, um, it might win, it might lose, but does the broker lose?
No,
How does the broker get paid?
they get paid on per transaction.
So if they buy or they sell, they get paid a transaction fee. So they make money regardless of whether or not you make money.
Now they do make some money to it. Like if they can really get paid on both sides.
They can have some incentives built in.
Yeah, absolutely.
Okay. So, but typically it's just working same way like the bank. You're giving other people your money so they can go make money in the hope that they will make you money as well. But
Absolutely.
if they don't make you money, they still get paid and you lose money.
Yes, that's very true. And there's a cap. So when mutual funds are having returns coming out at 8, 9, 10%. Just like what we've seen when the economy was like raging and everything was, you could be really invested anywhere and you were making money. Mutual funds were making a ton of money. Like, they're making a lot. And so they will just find new expenses to basically spend your money on. There's bonuses, there's marketing, there's all sorts of things that they'll spend your money on, and you won't be able to capture those profits.
But what's really attractive? I think the most attractive thing about the 401k is the employee match.
That is attractive
So
because that's almost like free money.
Right. So if I put in, if whatever I put in, if the employee is going to match 3%, 4%, 5%, 10%, right? Then, yeah, that's great. And so a lot of people, I'm laboring this point because this is one of the hardest things for people to see. But if, let's say I put in money into my 401k and my employer has a 10% match, right? Not everybody has that. Maybe most employers are lower, 5 or 4 or whatever. But let's say we just have a real generous employer, 10% match. All right. So that means I put in $1,400 a month, but the employer is also going to throw in an extra $140 on top of that. Right.
Mm-hmm.
So I'm feeling great. That's extra money. That's money that's going into my 401k. However, didn't we recently have a really big hit in the stock market where it went into the technical definition of a bear market? Wasn't that just like a
yeah, it really at the start of all of this COVID stuff, we saw biggest crashes.
Now there's been some huge gains that have come back, and the stock market seems to always be setting a record low, record high. Now, if I put in 1,400, and let's say you're my employer and you put in $140, and then everything crashes and I lose everything, am I still comforted that I had that $140 that you put in there? Do I feel good about that?
Not so much.
Did you feel good about that? If I was your employer and I gave you $140, it was all lost in the Wall Street casino, but
that's what really bugs. That's what I feel like a lot of, which is important for a lot of folks to understand this, that it's different between a mutual fund and the index funds, because mutual funds are the business, they're businesses that you're investing into. So if you may not even know how this business even performs. A lot of times Amazon is a way better performer than most of these mutual funds. So
sure. We had just had Guy who said, hey, you only lose if you sell. And
right.
I had a relative of mine who had this great stock, and then it just went down to like a penny, right? He didn't want to sell it. I think he still has it, but I think it's gone up. He bought it when it was several dollars a share. And now we're talking about like 15 years now, and I think the stock is valued at 3 cents a share. It's like, yeah, you don't lose any money, but then at the same time you still lose money because there's money that you don't have. You lost the opportunity because you could have put $1,400 into something today that could have benefited you right now, and you have $1,400 in something that you hope comes back.
Well, I think you bring up a good point that, yeah, there's in the investment, you make your money when you get in, but then also you realize that when you get out. And so in stocks, you can hold on to a stock and you won't actually realize those losses or those gains until you sell. The difference with mutual funds is they're buying and selling every single day. So there is nothing to hold on. So you will lose holding on to a mutual fund. And so when there's, for example, if you had a mutual fund at the beginning of COVID versus an index fund like the S&P 500, which, hey, everybody was raging about the economy, and then COVID happened. The S&P, which is the Standard & Poor's 500 biggest companies in America, it just broke out of where it was before all of COVID happened. So the economy's back, the stock market's back, but the mutual funds, if you were in a mutual fund, you wouldn't have regained that money that was lost. But if you were in just an index fund, you would now have recovered everything that was lost, because the value wouldn't have lost, it is still there. So that's what I think is so important. If you're going to stay in the stock market, you got to understand it. And I understand it, and I don't even want to be there.
So, but I mean, we have one of our business partners. Remember Steven? He
Mm-hmm.
he day trades, and I mean, the guy, on a good day, makes 5 figures, right? That's not too shabby to make that in a day, right? Doing some day trading, $10,000. That if you know what you're doing and you understand what you're doing, you're educated on what you're doing. I mean, I see the potential in investing in the stock market when you know what you're doing. But most people who have these 401ks, they don't know what they're invested in. Do they know if it's a mutual or in an index? Do they know? Uh, a lot of people just set it and forget it. Do you agree with that?
I agree with that. Yes.
Yeah. So, folks, we go over all of that because we have to look at this budget. $5,000 in, and if you add everything all the way up, it's $5,000 out every single month. So the cash flow is zero. But I mean, the whole goal, the reason why we're talking budget is we need to create positive cash flow. Where are there inefficiencies in this budget? I mean, can we somehow lower the mortgage payment or the car payment? I mean, how much can we cut back on the expenses? Should we go eat a beans and rice diet? I mean, what are we going to do here? So what we want to look at are where are there potential inefficiencies? So here we have a look at a budget, and it's the same budget we were just looking at, but just put into a spreadsheet. Now this spreadsheet we actually have. So when you buy the credit banking book, what's great is this is an active spreadsheet where you can type in your income, your different incomes, all your expenses. It has running totals. And so as you make different changes to your expenses, if you do cut back in an area or you do add something in, it keeps track of everything. And if you're somebody who thinks like budget is the B word, right? Well, you need tools like this to help you do this. Because a lot of people, they know how much money that they make, right? It's pretty clear. They can see the bank statements, but what they don't track very carefully are the expenses. So if we can come up with that, we can help find where the inefficiencies are in the debt. So how do you create cash flow? Well, you either increase the income, you decrease the expenses, or you do both. So how do you increase income? Well, I got a couple of suggestions here for you. You can change your tax deductions on your W-4. A lot of people, they don't even remember what they put on their W-4 for their deductions. And so sometimes people just put a 1 or somebody filled it in for them. And if you increase your deductions, then the lower the number, the more that they hold out for taxes. And a lot of people like that because they don't want to owe taxes at the end of the year. They want to get their money back. Except for you're giving the government a loan, an interest-free loan. I mean, what I suggest is get as much of your money as you can because it's your money, and learn how to start a business so that you can have tax write-offs. But what else could we do? You can decrease your 401k or IRA contributions. Oh no, my employer match. I don't want to lose that, right? We've been talking a lot about that today. But listen, here's another way of looking at it. If you could take the money that you're putting into the 401k right now and use that money to help you get out of debt, to help you learn how to invest more. And let's say you want to learn real estate or you want to learn how to be a day trader in the stock market. Well, get educated on that so that when you get out of debt and you have more cash flow and you have the ability to invest, you now are educated and trained and can do that very wisely. And so imagine where you're at right now, just total in your total indebtedness. and you're putting this money away into a 401k that's not ever going to achieve the full retirement potential that you want it to. Because most people, they work 40 hours a week for 40 years of their life. And then what's in their IRA? Well, about 40% of what you lived off of when you were working full time. So this is where people need to see that the 401k is not the end all be all. It was never designed to be the end all be all. And so it's a great tool that, I mean, I don't say that you should, close your 401k or anything like that, but stop contributing to it for a while. Use the finances to pay down your debt. Use the same amount of money to educate yourself on how to invest your money wisely. Then use all the cash flow once you've eliminated your debt. Maybe if you want to go back into 401k, go ahead, go back into 401k or start day trading. But you will begin to actualize greater returns because you took the time to educate yourself. You took the time to get out of debt to create more cash flow so you have more money to invest. So this is a great way to look at a short-term decrease to the 401k or IRA to later come back and then just blow it out of the water. So some people talk about, well, what if I worked overtime or I picked up a second job? Well, right now there are a lot of opportunities. I know we've had a lot of clients who picked up some extra work using Uber Eats. This again should be considered a short-term solution because, I mean, the more time you spend working, right, that's less time you have to be with your loved ones. So that can create more problems right there for you. So you got to be careful. But that's a great way to boost some income over a short period of time. You could sell off an asset to pay off a liability. Now, some people are like, how is that increasing your income? Well, it's the net increase to the income is what we're looking at because you might have an asset. Some people are holding on to some assets, but you know what? They're just not paying off. They're not paying off like they should. They might not ever pay off like they should. But if you sold that asset, there might be enough money there to take out a huge liability, like maybe one of the car payments, right? One of the autos could be paid off, and now that frees up $300 in your budget. So whoosh, that's a huge thing to consider. But some people were just like, oh no, I've got that stock or I got this old thing, and it'll pay off someday. Someday my prince will come. I mean, you could think that way, but that's, or we could get realistic and say, what could we do now to make a positive impact on my finances? And then last but not least, start a business. I mean, I already mentioned that, I kind of alluded to it, but create multiple streams of income. When you start a business can instantly, you can start getting into referrals, network marketing. I mean, there's so many, you could start a lemonade stand at the end of the driveway, whatever it is. You start a business, you can have people work for you and work the business. There's so many different online businesses where you can make money while you're sleeping, but start having a business that you can set up and have it bring in some more income. Make your business like another member of your family. Imagine being able to put the kids to work and have them pay you money. Well, put the business to work and have it start paying you money. Right? So how do we decrease the expenses? Well, we can look at all of the automated payments for duplications. Right? How much money have we been able to free up, would you say on average, Ray, with helping people look at their automated payments for duplication?
Easily $50, $100. We've seen like a lot of just automatic Amazon apps and Amazon, things like that. We got a 7-day trial of, Stars TV channel, or kids are watching this, and it all starts to add up really quickly. Music,
$7 here, $16
audiobooks
there. Right. And so, yeah, we go through and we look at, and some people don't realize that they have duplications, meaning they're paying for more than one service twice.
Mm-hmm.
Right. Because
promotional periods are ending or have ended. Internet, that's, you have a discount for 12 months and then you've been paying for the last few months, you're like, wait, wasn't that cheaper? But by the time a couple of months goes by and you're like, why is it so expensive? And then, oh, I'll get around to that. And then a few months later, okay, I should really do something about that. Oh, your promotional period ended 6 months ago.
Exactly. Look for better payments plus rates with creditors. There are so many people that are into different types of loans. There's all kinds of loans, but sometimes when you look for better payments and rates, these are the type of loans we're talking about. Like a student loan fits really well in here. I mean, could also talk about refinancing debt, negotiating forbearance, or the deferment of payments. So when we look for better payments and rates, what that means is um, who's your credit, your internet provider? Who's your cell phone provider? And who's your auto insurance carrier? So you start looking at them and what are you paying? And what's your rates? Well, if you tell them, you know what, I'm going to, let's say you're with Progressive and you're going to go with Geico, or you're using one insurance carrier or you're with Verizon and you're going to go with AT&T. Well, they have customer retention programs or departments where they're going to offer you a better payment or rate or give you some kind of maybe 1 month free or something like that to keep you as their customer. But you can actually shop around and you might be overpaying for a service that you're using. We've seen people spending hundreds of dollars on cell phone bills and been able to switch them over to things like voice over internet protocol, VoIP, and save hundreds of dollars. So sometimes you just got to look at where the best deals are and the rates. But refinancing inefficient debt, we'll go over that more in a later training. But a lot of people say, "Oh, should I refi? Is it time to refi?" Well, yeah. If the refinancing, see, a lot of people, they only look at, did it lower my minimum payment? Well, sometimes you can lower your minimum monthly payment and end up paying more over time. And that's not really an efficient way to take care of your debt. However, if you have the ability to pay less over a shorter period of time, well, now you've made that more efficient, right? Or maybe you're going to pay the same, but you've shortened the time. So there's a lot of different ways. You're looking at the term, which is the length. You're looking at the interest rate. You're looking at the principal payment. So there's a lot of different ways that we look at debt and how we can refinance that. Most of the time when you're working with the bank on the refi, they want to throw in extra things and they've got fees and things like that. Before you realize it, you're paying more than you were before you started. And that's really inefficient. So negotiating forbearance or deferment, that was the one I was talking about, or I meant to talk about with regard to student loans, because right now, I think everything is under forbearance or deferment right now. Everything's under deferment to the end of the year. There was an executive order signed, so for student loans, so that's good. But you're still going to have to pay that back, and those notes can be sold to other buyers, and so you got to be careful about that. And let me see here. One moment. All right. So as we look to eliminate our duplications, and we look for better payments and rates, and we look to refinance inefficient debt and negotiate forbearance, we also need to consider starting a business to get write-offs. Write-offs, what's great about write-offs is they help us to completely eliminate expenses. Imagine converting legitimate expenses into your business, and when you write that off, that flows to your bottom line, meaning you get that money back. When you do owe taxes as a business, you don't have to pay that because you have the write-offs. You save tax, save the money, so the write-offs are really important. All right, so when we look at the two-income American family, we look at this budget, where are there inefficiencies? Well, we'll get into this more later, but what we do is we take the money out of the checking account. We put it directly into the lines of credit. That means we don't have to make that minimum monthly payment on the credit card. You don't have to make it. So where does that money go? We budgeted $600 for that. Well, where does it go? It goes to the cash flow. But then let's also talk about that money we're putting away in the 401k. Are we really willing to keep doing what's not working? Right? I'm suggesting you consider pulling out a portion, if not all of the money that you're putting every month into the 401k, and using that and putting that into your cash flow, using that to aggressively pay down your debt in the here and now, so you can free up more cash flow to invest more even later. So by doing that, where does that money go? That goes into our cash flow. So now we have to make a house payment. We got to make car payments. We still have all of our lifestyle expenses, but we freed up $2,000 in cash flow due to some inefficiencies in this current, looking into this current budget. All right. So folks, I know I took a lot of time going over that. We covered a lot here today, actually. So when you start putting all the pieces of the map together, the budget gives us the cash flow, which is our fuel. We'll learn about lines of credit and loans. And then we put that all together so that we can use the cash flow to help us use our lines of credit to aggressively pay down our loans in about 1/3 the time. Now, we're going to do a case study here. And today's case study is where I feel like a lot of people have been at. We've been talking to a lot of people, and some people have a lot of cash flow, but I've been getting a lot of messages from a lot of our folks, and they've been saying, well, what do you do when you have like little to no cash flow? Well, here's what we're going to cover today. We've got somebody that this month, the month of this month we're in, the month of August, started a new 30-year mortgage, $189,000, and they also have $4,000 in credit card debt, but they have less than $500 in cash flow. Well, we're going to show how we can completely, with that small little bit of cash flow, eliminate all that debt in less than 18 years. So you definitely want to stand by for the case study. And if you're in the Zoom webinar, you're going to be here. For those on YouTube, you definitely want to get into the webinar. But what we want to cover right now, Mr. Fleming, can you take control of my screen?
I should be able to there we go. Did that work?
Yes, it did.
Let's see. Hey, I can control it. All right. So you may be thinking, like, how does this fit into the big picture? Where does credit banking fit in? Well, this is just one of the 5 systems of wealth, because wealth really is a mindset in understanding of the systems. So there's business. We talk a lot about business. We talk about taxes. We talk about credit banking, talk about real estate, and the understanding, the education of all of that. Because if you don't understand these systems will take advantage of you. So you need to get educated so you can leverage these systems to your advantage. Tonight, we're going to be talking about real estate, how to build equity, build security, massive income potential, also the ability to create that passive income that we all seek and desire. So growth is a mindset versus, let's talk about a growth mindset versus fixed mindset. You know, we talk about a lot of different ideas. I always like to relate this to trying on pants. You know, you go to a store and you try on some pants, you try on some new ideas. And if it doesn't quite fit for your situation, then maybe you got to try on a different pair, and maybe this one has different pockets, but you tailor it to fit your situation to what will work for you. That's really what we are wanting you to be able to do. Is a fixed mindset might be, hey, I had these pants before. I'm going to order the exact same pair that I ordered last time. I'm not going to try anything new. And you could be missing out on some really big opportunities by not being flexible. Right now, with the way that everything is changing, Change is the name of the game, and being able to adapt to that change is what's going to get you through. So there is playing by the rules, and there's playing with the strategy to win. Let's talk about, you may or may not have ever been in a casino, but I think we all understand what a casino is. It's a gaming institute. It's where you could go and gamble against a business ultimately. And so there's a game in there called blackjack. And so if you're playing blackjack, there's basic strategy, and the casino makes its money by playing odds, and it's wanting you to basically play a basic strategy. You can improve those odds by counting cards. It's not actually illegal. It's just really making a better, you're playing statistics, and if your mind can actually keep track of the cards that have come out to the table, you can improve the statistical probability of being able to win. Now, where does that come into play? Credit banking and understanding real estate, understanding these systems, what you're doing is you're increasing your statistical probability of winning at the game. The systems that are in place are very similar to a casino. They want you to just go in, show up, have a good time, and lose your money. It was not built for you to become wealthy. So you need to actually start learning the game that you're playing and become a strategic player. Just like in chess, where if you know the strategy of the game, you can actually have a game. You're not necessarily going to win. Whereas if you are a master, you would already be thinking 20, 30 moves ahead. That's where we want to get you. You may just not even know the rules of the game yet. We want to teach you how to play the game, and it will be up to you to take it to the next level where you start to think, okay, not just 30 days, but 1 year from now, 5 years from now, 10 years from now, and how you are going to be on that 20th move, which is 20 years from now. That's the key to success. If you look at Jeff Bezos, so he says, what is not going to change? People are always going to need certain products. They're always going to need books. Their books are always going to be around, even though they're going to change their shape and form. People are always going to be shopping. People are always going to be listening to music. And so if you look at everything that Amazon has in place, these are foundational items in our economy. And so he's built a business around that. But he also started 25 years ago, almost 30 years ago now, building that business. And so that's where that iceberg illusion comes into play. A lot of us don't see him, for the first 5-6 years when, they were really, really struggling and not, working out of garages and things like that. So that's where you are now. You're in those early startup stages, and we really got to be looking at that long-term goal. So what is not going to change? People will always need housing. Rents increase over time. Real estate investors make money in good situations and bad times. So bad markets, there's actually, if you think about it, it's a little against what we're believed to think. When the real estate market crashes, we all feel like that's a bad thing. But in reality, that's when real estate goes on sale. Right now, we see some of the highest values for example, in Southern Arizona, in Tucson, there's literally 30-day supply of houses. A healthy market usually has about 6 months worth of houses, somewhere between 4,000 to 6,000 properties. We have about 1,300 that are on the market. There's just no properties to be able to find. It is a complete seller's market. And so when we're seeing 70 offers on one property, is that the best time to be buying when everybody's paying beyond retail? Or is the best time to buy when everything is on sale? Something to think about. You are responsible for making your dreams become a reality. This world is not a crazy enough place to start rewarding undeserving people. And it's hard to hear that sometimes. So they are not making more land, and it's a scarce resource. A little bit off of Dubai, but for the most part, land is not, there's no more land being created. And those who know these strategies make more money than those who don't. It's the systems. So understanding real estate, understanding how to get your real estate debt free, getting out of your mortgage, expanding, getting into some more real estate. And I'll tell you one thing, because you might be thinking, Ray, I don't want rental properties. I have some fears against that. But let me ask you this. If you have some fears against rental properties, where did that come from? Somebody may have told you something along the path like, oh, tenants are going to destroy your properties. But you want to think about who has been sharing the information that you receive. I guarantee you, if somebody told you that and they've been very fearful, one, they didn't have the education and they got into it without knowing what they're doing. Or two, they heard it from somebody else and they've allowed that fear to never let them try. So if you have that fear, don't be fearful unless you try it. But Mr. Smith, I think that kind of, let's talk about the real estate fundamentals. Okay, so how do you find properties? Well, first you have to actually find them. That's the key, finding your properties. We have a system called Renatus iOS. And so Renatus is a real estate education company, but it also has an investor operating software. This software helps you find properties. It helps you locate deals. We're going to spend some time. We'll make another webinar or video about really diving in deep about this system, because this system is truly powerful as far as your ability to find people, properties, and money. So if you look, you can run a search and find foreclosures in a certain area, and look, wow, almost 6,000. So there's some really big opportunities there. And those are people that need help. And so next, you got to be able to fund it. You got to be able to fix it. You got to put a tenant in there. You got to put in a management system. Or a property manager. And then, or you're going to manage the fix and flip, and then you're going to sell it. All of this can actually be done in that system. But also, when you understand this process and you go through it successfully, like Joseph said earlier, we haven't lost any money yet because we learned how to do it successfully from other successful investors. And all we do is wash, rinse, and repeat. We know how we're going to get out of it. So we know the 3 different ways that we're going to get into a property. And we also know at least 3 different ways that we're going to get out of it. So if we are in a situation where we may lose money, well, let's change directions. Let's adapt. Let's move to a different strategy. And that way we don't lose money, and we can, maybe it just takes a little bit longer, but we'll make money over time. Go over to followustofreedom.info, where you can see our network of real estate investors, what we're doing on a weekly basis, getting together. We're masterminding, we're strategizing on how to find properties, how to be successful in business ownership, how to create that financial path that we all want to go down. And it's better to go with 20,000 others going in the same direction than really lone wolfing it on by yourself. So Mr. Smith, I think that wraps it up for my pitch for why everybody should be a real estate investor.
Perfect. Thank you, Mr. Fleming. All right, so we're going to get to our case study. This is going to bring us to a close for the YouTube video. We want to encourage you to come on over, join the webinar, be a part of the mastermind where you get to interact with us directly. wiseguysandties.com/events. Register for the Credit Banking Mastermind, where we are going to go over a case study right now. But for those on YouTube, I want to thank you for joining us. Have a good night, and God bless.